Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work now for a while. He has a great Twitter, bond strategist. He's been doing interviews on Real Vision TV, Danielle DiMartino Booth interviews with her, also George Gammon, a couple excellent interviews in the last 4 or 5 weeks, I would say. He's a bond market veteran with over 20 years on the sell side and buy side. He's worked at primary dealers, including Nomura Securities, first as the chief U.S. rate strategist, later as the head of fixed income strategy for the Americas. He's also worked at a number of other investment banks as senior fixed income analyst at Morgan Stanley, Bank of America, Merrill Lynch, and he's been an active guest on TV, including Bloomberg and CNBC. George Goncalves, thank you for joining me.
Jason, great to be here. Thanks for having me.
Yeah, I hope I got your bio right. I mean, you have an incredible list of credentials in the bond market. You are truly the bond strategist.
You know, I've been blessed, and it's been an interesting ride for sure.
Okay, so before we talk about corporate bonds, government bonds, let's get your views on the global macro situation, because the global macro situation, what happened with the coronavirus, it caused a cash flow problem, pervasive throughout all levels of society. And then there was a corresponding actions by the corporations after that with the revolving credit facilities. What do you think happened over the last 4 or 5 months to the corporations? They were all planning with their cash flow projections that 2020 was going to be a fairly stable year. And then the coronavirus just comes in and throws a monkey wrench into everything.
Yeah, look, I think even heading into this, before we had the real kind of fallout from COVID and back in February into March, when you really saw a pickup in corporates panicking. Yeah, you had these assumptions made, which this is a global kind of phenomenon. Many of these companies being multinationals, a lot of them being energy and commodity type producers that were making expectations of cash flows for dollars based on commodity prices much higher than where they are now, let alone not expecting negative pricing in oil. And of course, the whole commodity complex has been struggling for weeks and months now. So you have that. You have the linkages back to emerging market corporate credits that also are highly dependent on dollars. So it was a global kind of cash crunch, cash/credit crunch that just kind of exacerbated when everything got shut down, and the lack of sort of just money flows around the world caused for these kind of acute, sharp moves in markets. But I think heading into this, we have to put it into context that although there is every year, corporate treasurers and CFOs and CEOs are always optimistic and thinking that this year is going to be as good or better than the following year. We have to think about the context and the backdrop of what was already in place heading into this 2020. One of the longest cycles on record. You already were seeing some issues around how money markets and the dollar funding was operating starting in September of 2019 with the repo crisis, and really just kind of starting to show that there was competition between treasuries and credit. And I know we're going to get more to that topic later on in the conversation, but I think this competition, the crowding out of available balance sheet and dollars to fund all these securities, it was already starting way back then. So you had this, build up into the end of the year of 2019, starting off this year with everything looking like it was systems go. And then COVID did indeed throw a monkey wrench into it. But the patient or, the global economy was already in a weak standing. And I think that, plus the fact that, we've lived in a world of just-in-time management, not just from inventory controls, but also with how corporations run their cash management, that corporations were running very lean and not having much actual rainy day funds to actually weather any sort of storm. And so when you force this kind of lockdown, slowdown globally, there's no actual earnings to be had anywhere. It really put these companies in a tough spot.
Well, I think the main problem is not necessarily just earnings. It's cash flow. So you need cash flow to service that debt. The debt payments come out of the debt servicing comes out of operating cash flows. So if cash flows, what these CFOs do, and they've been leveraging their balance sheets up like crazy, is they have an acceptable range of cash flow, right? Where if things drop below an acceptable range, then things start to really get in trouble. And that's how you have the situations in the last couple of years where General Electric and other companies where their cash flows dropped, their revenues dropped, and their cash flows dropped, and their debt load that they had, the numbers, the math just doesn't work because the cash flows dropped too much. And I think that's what happened with the corporations. But you can talk about in February, I think mid to late February, early March, the average person just doesn't understand how bad things got in the credit markets, in the bond markets. The stories I've heard from friends, podcast listeners and ratings agencies and bond fund managers are insane about what happened. And then the Fed stepped in, George, and they issued all these press releases. But did the Fed actually buy anything?
This is why I feel like there's a lot of smoke and mirrors, which we can kind of get into. And part of those press releases were announcement effects trying to calm markets down and take away some of the jitters. But there's a symbiotic relationship between the credit market and the bond market and the treasury market, and how interest rate volatility and how volatility in general will change the sizing of positionings at hedge funds, at large investors. And when we start to see an increase in volatility towards the end of February into March, some of these positions, were basically being forced into margin calls and not being able to hold on to these positions. And so it had a ripple effect starting from the bond market all the way through the credit market, which then forced investors to de-risk or just sell their assets because they could no longer either fund those assets, or those assets were actually starting to go down in value and they were getting these margin calls. Either way, it was a mini episode and very acute of what we saw in 2008. I mean, kind of what happened with long-term capital back in 1998, in a much smaller scale back then, but that was a big deal in 98. But this time I think it was just kind of, I feel like every single crisis that we've had in the last 20, 30 years, we just build upon it and then we just make it bigger. And so we haven't really learned our lesson on that front. And the Fed always comes in and rescues everybody by providing all these liquidity facilities. And to their credit, they really cannot just let the whole system implode, right? So they need to kind of put a safety net in place. But in many ways, hopefully in the future, we're going to take a closer look and understand how did we get to this place once again 10 years later, when they were telling us everything was fine, that the banks are perfectly fine. And the banks indeed were not the cause of the issue this time, but the financial system at large should not have had to go through this kind of cardiac arrest because of this shift in volatility around a health crisis, right? So I think, there's a lot of things that have been conflated and tried to provide some sort of cloud cover to say, hey, look, it was really because of the health crisis. And in fact, it was just too much leverage in the system and bad positioning facing a massive kind of margin call triggered by volatility. When that happens, I mean, it can get really ugly.
Yeah, I have a chart here from an April 1st Zero Hedge article about which industries drew their revolving credit facilities. And there was an insane amount of borrowing by auto and auto parts, retail, consumer staples, energy and commodities, aerospace and defense, hotel, resorts and cruise lines, airlines, tech, industrials, services, restaurants, casinos. You could go on and on down the list. Most of these large cap companies on publicly traded exchanges, they drew over 60% of their revolving credit facilities, George, in a very short amount of time, hundreds of billions of dollars, because of that cash flow problem. So they had their cash flow projections, and then the monkey wrench that came in, all those cash flows dried up. And so they went to even more credit, which long-term is going to be very, very dangerous if those cash flows do not come back in the next 6 to 12 months.
Yeah, that's a great point. I mean, and this is where it really gets problematic because we've been doing this again over and over again, solving a debt crisis with more debt, both at the government level, but also in the corporate level. And we can discuss later on how big the corporate market has gotten relative to the economy and how big the overall treasury market is. I mean, we're starting to get very similar to what Japan has been in for many decades. But if you look at the publicly available data from the Fed, which is the H8 data, which kind of corroborates some of that Zero Hedge article that you're referencing, but even more so because it continued to kind of update. From what I can see, over since March until now, over 800 billion in commercial and industrial loan growth and other loans and leases were tapped, and in a more normal economic expansion when you see, commercial and industrial loans going up, not at that speed, but when they're at least going up, you're like, well, that's a healthy economy. We're starting to lend to those that need it to keep the economy growing and investing. But that sort of acute, fast increase, which was almost like 30% increase in commercial and industrial loan growth in a matter of weeks. And then what they did with that money was the interesting part, because if you look at the M2 growth, there's a very close correlation, which kind of has to be that way because the cash had to go somewhere. It's not as if these companies raised all that money and then went and bought plants and equipment or did buybacks because they were not in the position to do stock buybacks. So they literally took that down, all these credit lines, in fear of those lines being cut on them, most likely, right? So they were probably in fear that, well, if this is a really long lockdown and we have really no operating cash flows for the next 3, 6, 9 months, we got to hunker down and take down as much of those credit lines as possible. And what they turned around and did, they deposited as cash. So basically, it's like an expensive way of kind of protecting yourself, but it goes to show you that they had not enough cash on their balance sheets to begin with, that they had to tap the lines in order to kind of weather this out. And I think, that plus all the years of stock buybacks funded by credit on the corporate bond market side, I mean, we're left with really highly leveraged companies heading into a recovery that, people are speaking of the recovery. We haven't really gone through the full downdraft of this, what is a small depression. It could be a longer depression, but this is, some of the sharpest economic contractions that we've ever seen since the 1930s. People are dismissing it because, well, it's a one-time hit. It's going to go away. It's going to bounce back. They're being very dismissive of the longevity of this slowdown. But on the other side of this thing, who's to say that we're going to, go back to 100% of kind of capacity and then be able to actually pay off all this credit that was taken out as a, proxy for a rainy day fund?
The analogy I use for these corporations is, I think what they did for people on Main Street to understand this better is they took out their credit card and they went to the first ATM they could find, and they didn't care about fees, and they maxed out the credit card for as much cash as they could. Because if you look at the borrowings as a percentage of the revolving credit facility, some of these industries took out way over 80%. Some of them are almost 100%. They literally took out as much as they could.
Oh yeah, these lines operate like credit cards, basically. They're very short-term in nature. You're supposed to pay them back in short order. It would be the equivalent, which would be a really uneconomic decision to do for the everyday, consumer. You don't want to go borrow from a credit card because the interest rates are much higher and the fees are higher. But when push comes to shove and you need to have cash flow to kind of survive for the next 3-6 months, that's what corporations did.
So I want to walk through a timeline with my listeners. I already did this for my paying customers, my patrons, in the last week or so. So the Fed announced with a press release a program called the Secondary Market Corporate Facility. And there was the junk bond markets, the corporate bond markets in February. The credit markets had froze up. The Fed was panicking. It was worried. Hedge funds were blowing up. Hedge funds were getting bailed out, from what I've heard from sources, because the risk parity trade and the basis trade were blowing up. I spoke to hedge fund manager Jesse Felder on Twitter about it, and he said it looked like to him that there was forced liquidation days for some large hedge funds that were doing that trade. So the Fed issues this press release, I think, on March 23rd. And the market starts to think, oh, the Fed's going to start to expand its balance sheet then. The Fed's going to start to buy up these corporate bonds. I saw on Bloomberg, George, an interview with bond fund manager Bruce Richards. He said the Fed was going to buy over $3 trillion worth of investment-grade corporate bonds. But how much has the Fed actually bought so far? If I'm checking the press releases, it seems there's press releases on May 5th and another story on May 4th. New York Fed says it will begin buying ETFs in early May. But that shocked me because we have the Fed issuing the press release, and then we have these other stories coming out 6 weeks later that they didn't buy anything yet.
That goes to show you the power of forward guidance. I mean, the Fed still has a lot of credibility with markets, and people believe that eventually they're going to come in, and they are right now. But it's really a fraction of that $3 trillion, and I can take the other side. I mean, I can't personally take the other side because I don't have $3 trillion to go in short on the other side, but I can tell you that I doubt they're going to get to $3 trillion. If they get close to $300 billion, will be a lot, in my humble opinion. But as we speak, from the last Fed balance sheet update from yesterday, Thursday the 14th, which was as of Wednesday the 13th, they have financed, because they kind of have a technicality. They're doing it through these SPV programs. It's not technically buying their liquid, it's a liquidity kind of financing project, but they're holding 305 million of something, because they don't break down if it's the ETFs, if they actually bought specific, corporate bonds. My hunch is that the easiest thing to do is the ETFs first, and it's probably what they went with this week. Is my humble guess. Basically, March 22nd, 23rd, all the way through this week, they had done zero.
Wow.
And in that time period, though,
it was a bluff.
Well, look, I think partly it just goes to show you that a lot of this stuff was like shock and awe, and it was, let's get as much stuff out there to say, look, we have a huge laundry list of how we can support the markets, but we don't know how exactly all these things are going to work. I think realize it's really hard to set up these programs, and I think they enlisted outside money managers.
Would you call it manipulation by press release then?
No, I wouldn't go that far. The Fed's not trying to manipulate anything. The Fed. Look, if you listen to the way Powell, and I'm not a Fed apologist, trust me, I'm far from that. But if you listen to how they've talked about this, I think they're coming to their own conclusions that there's limitations to how much they can do. They're not going to take down all the markets. That's why that 3 trillion number is a little bit outlandish. And it took nearly 6 odd weeks to kind of get this thing operational. And the first go at it, they do 300 million. Is that really that impressive?
No,
it's a rounding error.
No, but look at one of the net results of this is that the first week of April, these large corporations were shockingly able to raise over $110 billion worth of new corporate bonds, investment grade corporate bonds. Some of these corporations were borrowing at 75 basis points above the Fed funds rate. So not super high borrowing costs for some of them, even though they're adding a lot of long-term debt to the balance sheet. So I guess that was one of the main goals of the Fed, was to restart the borrowing for large corporations. And that's around early April is when the stock market rally started, after the corporations, the large ones, started to raise more in bond debt.
Yeah, there's definitely a clear connection there. But I go back to this kind of symbiotic relationship that I keep mentioning between treasuries and credit. And this is all about narrative management. They're talking about market function. Yes, it's completely about market function, but it's the market function of the treasury market so that it's stable. It allows corporates to kind of stable and price better. And that's one angle from a pricing standpoint. The other connection between credit and treasuries is that we've had this crowding out competition for the last 6 months, really to the last year. And by the Fed buying, close to 500, 600 billion per week during those weeks of late March, early April, they took down so much of the treasuries out of public hands that those investors went and bought credit with it. So they were able to finance all those corporations. So the actual QE this time was about market function to help treasuries, but the secondary benefit, which kind of gave them time to set up this credit facility, it created a huge hole in investors' balance sheets. They're left with all this cash. They went and bought credit. And the corporations were there to issue in droves. The actual levels that I'm seeing versus history on a gross basis, these are record months. March and April, I think, are beyond any other month that I've ever seen on record. And that would not have been possible unless the Fed would have taken out all the treasuries and then created this vacuum that it had to get filled with some other fixed income. And that is how they solved this credit dilemma.
Very interesting. Do you agree with the tweet that Jeff Gundlach put out? He thinks that the Fed is trying to cap the interest rates that investment grade corporate bonds, these large corporations, can raise at. He said if it goes above 3% for some of these large corporations, the investment grade corporate bond yields, these large corporations, they're going to be in a lot of trouble with the debt on their balance sheet.
The Fed's got they're definitely got the world on their shoulders. Both from the issuer corporation side, but also from the investor side. I put together some charts and looking at who owns all this credit. A lot of it is the pensions and the insurance companies. So on the one hand, they want to make sure that the corporations are not going to see a spike in interest rates that would make it nearly impossible for them to roll over their debt, and then that leads to unnecessary either fire sales or worst case scenario defaults. that's one side of it. But on the other side of it, there's the investor side, which holds, trillions and trillions of this stuff that is backstopping, technically mom and pop and insurance programs, all throughout the nation, around the world. And so Fed's got like both of these things on their shoulders, that they cannot let rates go up too high, because the mark-to-market hit on some of these corporate bonds would see, an actual impairment in some of these, portfolios. And on the other side, corporations may not be able to issue if we're heading into we are heading into an economic slowdown. The question is how deep it's going to be, and if their funding costs are spiking, their chances of surviving are very low.
Are we still seeing a lot of credit ratings downgrades from the agencies? Because we talked about how much debt is being issued. Wolf Richter of wolfstreet.com, he's been talking lately on his podcasts and articles that when you add up all the revolving credit facilities being drawn in the last 2.5 months and the new corporate bond issuances, it's over $600 billion in new debt for corporations. So wouldn't you think, if there is potentially going to be a cash flow problem, especially for oil companies, but obviously some other businesses are going to have, they're telling their investors right now for the Q1 earnings that it's only temporary. The cash flow will be back in next quarter. The worst news is already behind us. And 6 months, 12 months from now, all our cash flows are going to be back to close to pre-coronavirus levels. Do you think that we're going to start to see a lot more downgrades soon?
Well, we've had a number already, right? And we've had, what looks like one of the biggest, fallen angel moves out of investment grade into high yield since the 2016 oil shock. But that was for the full calendar year of 2016. We're only, 4 months in, if you think about the ratings calendar. And the economy, again, is not poised to really just turn on the dime as some think it will. There's going to be more, in my opinion. It's going to be very difficult for the rating agencies not to actually, start, taking into account the additional leverage, the lack of, operating cash flow, and just, really poor economic outlook. These companies have to get downgraded. Now the question is, just don't downgrade for the sake of downgrading. I think that there's going to still be the standard process, and it might be a little delayed by the time they figure everything out. But we go through these shocks. You get downgrade cycles, and then the worst case is defaults, right? And so we're not even at the the beginning of the end. We're at the at the end of the beginning for the downgrade cycles, and then where that leads us, is it a default cycle, and can we get the economy up and running fast enough to avoid that? That's where my head is at, and that's not where the market is.
Wasn't there about 150 billion of credit ratings downgrades on some of these investment grade bonds in about a week or two, a record?
Right now, we're talking about laws of big numbers that, and I'm usually pretty good at keeping track of all the numbers. There's so many big numbers flying around. Look, we should expect these sort of big shifts going forward, and that's par for the course in my view.
I want to get your opinion on the oil industry before we move over to government bonds and central bank balance sheets. Your opinion on the oil industry, because it seems that they took on the shale oil. I would call it a bubble. It was a credit bubble. The shale oil production was growing enormously. I would say it was indiscriminate of oil price for a while. That shale oil production growth was growing no matter what the oil price did. And here we are now. We've seen a couple bankruptcies so far in the oil patch, with Whiting Petroleum in the Bakken in North Dakota, too much debt on the balance sheet, higher cost oil producer, and Diamond Offshore, one of the deepwater offshore drilling companies. But we haven't seen a lot of bankruptcies yet. Do you think that industry is going to be one of the ones that's more disproportionately affected because of what's happened in oil?
I'll talk about the pros versus the cons, right? There's plenty of cons, so let's try to start off with something positive. There's decent consolidation that took place in 2016, as you are well familiar, and any of your listeners that track this much more closely than I do. I'm more of a macro fixed income strategist, and I watch what's going on in the energy sector and broadly speaking how those companies are faring. But there was decent consolidation that took place. There's a lot of the weaker hands got washed out in 2016, the first kind of oil shock. Not to say that we won't see further either bankruptcies and companies really having to consolidate further. All you have to really look at is the triple C bucket of the high yield market. It's even with all of this so-called Fed support, we have like a really bifurcated credit market where the lower rated credits are not what the Fed's ever going to touch. I mean, that's, I don't think it's going to take place.
So you don't think the Fed's going to want the cruise ships as collateral?
No, I don't think so. If it sneaks in there somehow, it'll be through some sort of CLO type thing, and that's through the TALF program, but who knows? But like outright, I mean, the way these facilities are designed, they're really designed to lend to the best collateral. I mean, I was not a big fan of them going down the credit road, but they're there. But even if you look at the term sheets of the credit facility, a lot of it is geared towards 1 to 5 year paper. A lot of the credit issued in both, especially in investment grade, is beyond the 5 year sector. So there's no way they can actually take down 3 trillion, let alone 300 billion, unless they change some of those parameters, which is possible. But as things stand, the Fed's credit facility won't really bail out the energy companies, and they really need and hope that this bounce in oil is sustainable, and that we don't see a kind of a second wave down into the summer and into the fall on the economic side, because then it's going to be really hard to climb back. I mean, my personal view, which I know we're going to get to later on with the Fed, but everyone's like, oh, the Fed is going to bail out everything. The Fed is now got its its ducks lined up in a row. It's got all its programs. It might be able to launch 1 or 2 more, who knows? But pretty much I think they've done what they had to do. The shock and awe is done. They can ramp up all these programs, but they're not going to save the high yield market. I mean, the best that they're going to do is that borderline between IG and high yield, the fallen angels that were, of IG quality back in March. Beyond that, we're going to have a bifurcated market. And that's why like tech trades the way it trades versus, small caps. And we are literally creating a big versus small, which I'm not a big fan of, but the smaller companies, as well as the energy companies, are usually the lower rated companies, as we all know.
So it's all about who can actually get the liquidity. And so the market's starting to worry about, well, if they need to go, no one can raise, especially if you're an oil company right now, you can't really raise equity. But the terms that a lot of these companies, they're not going to be able to raise a lot of debt. I mean, look at what the cruise ships just did. They had to offer all their cruise ships as collateral for 11%. It's insane.
100%.
So let's transition now to the dollar and government bonds and central banks. We're recording this interview on Friday, May 15th. The dollar index is above 100. If I would have told you that the Fed's official balance sheet in the last couple of months would go up well over $2 trillion, they would just issue a press release in the last week that they need to borrow another $3 trillion for the second quarter, and the dollar index and the trade weighted dollar would still be where they are right now at around 100 or above 100, would you have been surprised?
Actually, not really. I mean, I'm a dollar plumbing expert. I think I am. I've been watching this stuff for 20 years, and I started off in the money market space, and track those flows and have a good understanding of the plumbing. And again, each crisis that we go through, we don't learn our lessons, and there was a lot more dollars that were created, or dollar, liabilities and assets that were based on some assumptions of collateral and cash flows in the euro dollar or the offshore dollar market, the non-US banking system. And that has a huge hole still to get plugged. And, the Fed's kind of done a lot and has, these FX swap lines in place. They're not fully being used. They can go much higher than where they are, somewhere around 400 something billion dollars. They got over 600 during the financial crisis. And since everything since then is now a multiple of like 2 or 3x, I mean, you can easily see those swap lines going up to 1.5 trillion, if not more. From a supply demand, very kind of straightforward analysis, you think, well, there's way more dollars in the system. Why is the dollar trading so well? Well, it's because of that immediate need for cash flow and the immediate need to actually pay off your debts or you default. And so you will kind of bid up the dollar in your own like local currency to kind of get access to dollars so that you don't lose what you've built up for the last 10, 20 years in a corporation in an overseas market. So I think that dimension is still with us. This week was also the first time that we saw some usage of this other new Fed facility. It's called FEMA, but it's basically for foreign international monetary authorities facility. I think I got that right, but there's so many new acronyms. It's basically for foreign central banks that don't have FX swap lines. They can go and post their treasuries as collateral to the Fed and get access to dollars. Used for the first time.
So it's global. It's a global repo for foreign central banks, but it's called FEMA.
Yes. Yeah, interesting. So yeah, we got to help everybody out. Dollar for me, I think it's going to take a lot to really wrestle it back down, especially if I'm worried of a wave two, both in what's going on the COVID side, but also the credit wave two. I mean, the Fed has provided stability and liquidity and reduced volatility, but now we're going to move from liquidity to solvency and the ability to service your debts, and into an environment of a weaker economic outlook. This is where it gets, it could be more like the death by a thousand cuts. This is the longer haul drag of like where people realize, but hey, we cannot, afford to maintain all of these, operations, or we're going to have to sell assets, or we're going to have to, just kind of de-risk or reduce our footprints in certain markets. I mean, this is the part where I think you get, further demand for dollars for these emerging markets and foreign multinationals. And so that is still, I think, coming down the road. The Fed is now sitting and waiting and saying, hey, we got the tools in place. If it gets worse, people can tap it. But this is like the problem that I think a lot of the risk asset, cheerleaders that look up and say, oh, look, the Fed's providing all this liquidity. Like when they're doing that means something bad is happening. It's not usually a good sign that the Fed is providing all this liquidity. So if, we see a usage of FX swap lines going up, if we see, foreign central banks that don't have access to the Fed through those lines start to kind of, post their treasuries for repoing, that's going to be a signal that I think that the equity markets are not expecting, nor the credit markets. And then you're going to have a further kind of divergence between these small and big companies. The high yield and IG market will further kind of start spreading apart. And even within all those different rating sectors, within those sectors, you'll see even further differentiation. I think that's what lies ahead for us. And the Fed is just sitting here waiting. I mean, these credit facilities that they put could really, expand their balance sheet to like even double of where they are now. I mean, I know it sounds crazy, but they're $7 trillion.
A couple years from now, George, with the expanding of the balance sheet, I mean, I think it's good for gold, but do you think that it's going to be really, really inflationary? So a couple of years down from now, if the economy starts to restart, maybe a couple of years from now, 18 months, 2 years, that they're going to have to figure out how to start taking liquidity out of the system because there's going to be an inflationary problem with all this extra liquidity that they've injected.
Yeah. So, I mean, one thing that's interesting. So like the deflationist, and I'm much more of a deflationist by trade. I mean, been in the bond market for the last 20 years, seen the biggest bond bull run, been usually more bond bullish than bearish, but I've navigated a few times being bearish. It's been easy to be long the bond market. It's, we've been in lower rates, less and less utility from each debt that we add to the economy, the whole Lacey Hunt's kind of argument. I mean, I think that is very much true, but now we're getting to like the bottom of the floor of rates where they could go negative, but there's not much juice left in it, number one, from a trade point of view. You can trade it tactically. But what it means for inflation outlook, I think we still get deflation first before we get inflation. But what's different this year than 2008, where a lot of the gold bugs were up in arms saying, hey, look, we can't believe we're putting $1 trillion or $2 trillion into the economy. It's going to be inflationary. They overlooked the fact that most of that liquidity went into financial assets, and it went into being, rehypothecated into leverage and expanding all these kind of, new credit programs on Wall Street. This time around, most of that liquidity, or at least a good chunk of it, is going to go directly into Main Street. Not exactly as much as I would like to see personally. I mean, I think we should do more. Maybe the Fed will do more, and so will the fiscal authorities. But there's, given the sort of growth that we've had in all this money, they're not going to just take it back. It's going to sit there. And then the question is, can they really drain it? The ones that they could drain are these foreign operations, which will go down on their own naturally. So if we were to see some sort of last dollar big rally and FX swap line usages go up 1 or 2 trillion, that would probably go back down quickly. So if the Fed's balance sheet goes up to 10, it can go back down to 8. and we'd be like, oh, look, they shrunk the balance sheet. But it was really more just addressing that dollar shortage issue. But what they're doing with QE and what they're doing with these other credit facilities, it's going to be hard to turn them off.
Sorry to interrupt you. Congress seems intent, like almost every day now, they're talking about even larger $1 trillion plus. At first, the bailout for the states and municipalities a month ago was, I think the headline number was 500 billion. Then a couple weeks ago it was, $1 trillion. And then this week it was 3 trillion. And it's like, oh, we're going to start giving out even more checks to people. So they're talking about just more. Do you think they think that they can get away with this, Congress, the Treasury, Trump administration, as long as the dollar index and the trade weighted dollar are not weak, so they don't have to defend the currency?
Well, that's kind of the interesting part when you hear the president saying that he likes a strong dollar, but he likes negative interest rates. You have to pick one. But I think that they are indeed in the camp that the dollar is strong. Let's just keep putting stimulus in. And the weakness, and traditionally the purview of the dollar is in the hands of the Treasury, and so there's a whole debates around Treasury and Fed now are much more linked than before, and that's true. But Treasury basically kind of will be the one that if they want to break the dollar and weaken it, and that with the power of Congress spending as they are in these large numbers, eventually the dollar will weaken. The thing is, all of these things are about a matter of sequence and timing, as everything is in life. But we're still going to see deflationary concerns first. We're going to see a strong dollar, the shortages of dollars getting backfilled, and then there's that moment where we don't know exactly when it takes place because it's a moving target. But economies will open up again, and start to kind of figure out how to live in this new world that we're faced post-COVID, and we'll be with a lot of just extra money in the system. And for, going back to my earlier point that in 2008, 2009, all the gold bugs were wrong then because, the money went into financial assets and it cured assets at very cheap valuations and drove them up to astronomical levels. Now they're just trying to maintain these astronomical level valuations, which is debatable. And that other money that's going to be going towards, kind of more towards Main Street and to eventually, if we get an infrastructure bill, that sort of money is going to go into the real economy, and that's going to lead to inflation. And that's ultimately what they want anyway. So, I mean, could be a 2 or 3 year plan. I don't know when, but having been watching these sort of metrics and looking at modified forms of M2, we're going to right now velocity is dead because no one's really trading, or I'm sorry, not trading. No one's really spending or out there moving and putting money to work in the economy. Once we get through this, they're not going to just pull all this money out quickly. There's going to be frictions introduced back into inflation from just excess liquidity, supply chains coming back to the U.S. There's a whole host of reasons why inflation is got a good chance of coming in the next 3 to 5 years, and markets will sniff that out ahead of time, and it probably will be the precious markets that benefit quickest from that, and then it'll be what happens in the bond market, and we'll see how high that rates can go before we start to kind of cry uncle.
So to summarize what you just said in the last couple of minutes, I think the policymakers, whether that's in the Trump administration, Congress, U.S. Treasury, Federal Reserve, at least our central bank here in the U.S., they prefer inflation. So almost all the policy measures are to fight deflation, whereas another central bank, the policy measures might be different to safeguard against inflation. The policy measures here have an inflationary bias against them to prevent deflation.
That's exactly right. I mean, we are both, again, a reserve currency. We need to kind of keep producing more dollars to get it out there into the system globally. And we have an insatiable love affair with debt.
What worries me, though, is that, yes, they're papering over asset prices, and that's good for some baby boomers who have their retirement accounts for stocks going back up. Their housing prices are going to go back up. Bond prices are still going to increase because that's monetary inflation, and it's going into asset prices, stocks, bonds, and real estate. But that doesn't solve the cash flow problem pervasive throughout all levels of society. So you have governments at all different levels that are not collecting their tax revenues because there's not normal economic activity. People are not going out to bricks and mortar retailers, restaurants, bars, and so governments are not getting tax revenues from that. The small business owners not getting their cash flows, and then they're not able to pay their employees. So this is a vicious cycle, but the central bankers are papering things over, but they're not solving the cash flow problem. And the main thing I see right now with the global supply chain and the other distortions the central banks have caused is the cash flow problem.
And that's why I feel like, and I agree with you on that. I mean, I think that's why this this time around, if you saw the tone in the most recent press conference that Chair Powell televised, they're basically very much drawing the line that they cannot do grants, they cannot just give out free money, they cannot just create cash flow out of thin air. That's got to come from economic prosperity and the economy back up and running. And they're going to provide liquidity for those that are good credits and that could very well weather this storm. But there's going to be consolidation. There's going to be there's going to be some hardships coming ahead, and that means that we're going to see a reduction in asset prices, in my opinion. I mean, they're never going to televise that directly. I think that they want to have a controlled burn, and they want to make sure that we don't see like these kind of just massive drawdowns, and which are much more disruptive. But if we don't get the fundamentals to justify valuations on a whole host of asset classes, there's going to be a correction part two.
Yeah, I agree.
And that's where I think they want to kind of navigate us through. Whereas in 2008, 2009, the asset prices were already cheap. They were cheapening for almost since 2007. So there was a good amount of a runway of 15, 18 months of cheapening in credit. This was very sharp, fast. It's not, in my humble opinion, it's not over in 1 month.
Yeah, and they calmed down. If you look at the VIX, the volatility, they calmed it down over the last, 4 or 5 weeks. It's calmed down a lot. But I think that's probably temporary because, like you said, if the real economic fundamentals do not come back, people are going to start to really question the stock market rally. We're hearing a bunch of billionaire investors, Warren Buffett, David Tepper, Stanley Druckenmiller, really, really start to question stock market valuations publicly in the last week or so.
Yes, and so I think this we're in an impasse right now. I think the market's been trying to break one way or the other. But if we don't get, I feel like there's this real risk of you buy the rumor of the reopening, you sell the fact of the reopening, and you realize, hey, this is not really the kind of reopening of my grandfather. This is not your grandfather's reopening or economy of your. I think we're gonna realize that we're gonna be running at less capacity. We're also having issues with the China trade negotiation, and there's gonna be more tensions around that. We have an election ahead of us, and there is some semblance of, I say this huge tongue in cheek. Some semblance of fiscal conservatism of when you're doing trillions, you try to hold back a little bit. Maybe that's conservative. I don't know, but there's some fighting about how much and where to spend things. I don't think it's going to be as easy in the second or third round of additional stimulus from the government, and I think that all opens up for more volatility into a summer period. You have some of the PPP requirements for loans, getting called into question into the summer as well. And we have, let's not forget, 25% of the working population is in some form of unemployment. And a good chunk of those that are either furloughed or receiving, small business and medium-sized business that are receiving PPP loans that are using 75% of that money to pay for payroll, there's a good portion of, the U.S. labor force that's not operational, sitting at home. Not everybody can work from home on certain job tasks. You have to actually be at the job. Talk about 40% of the U.S. is not working. You're talking about some huge numbers.
The messed up things, George, that I'm hearing anecdotally is some people in some states, they're getting paid more money per week, $600 or more per week, to not work. So they're actually making more money now. Some of them almost $50,000 a year on an annualized basis to not work compared to their other jobs. So this is a really bad incentive problem right now for government.
It's a bad incentive problem, but also it's going to be a weird timing issue, because to kind of encourage these folks to come back to work when either they're worried about their health and a whole host of other issues, they're getting these, this sort of money. And, we still don't know how, corporations are going to react when they realize that they're not going to have the same sort of, operating cash flow into September, October, November, December in the quarters ahead. And there could be also a second round of layoffs, right? So that's naturally makes people much more conservative by nature. You're seeing a huge pickup in savings, which is the right thing to do, but people always do it at the last minute. and that's going to just hold back activity in the economy.
Are the policymakers going to allow people to save, though? Because we have a situation now where all these governments and central banks want to try to weaken the currency, and then look at the Fed funds futures, right? It's starting to price in next year, 2021, negative interest rates, even though we had Jerome Powell and the James Bullard, St. Louis Fed president, both say we're not doing negative interest rates. We have the Fed funds futures rates calling their bluff for next year.
Yeah, look, I mean, there's a lot of technical things going on there. We don't have to. A lot of people have written about it, but I mean, there could be some technical issues around, hedging for bank loan portfolios, because when you get close to the zero bound, there's only one way you can go after that. But I think the experience that we've seen in other countries that have, instituted negative interest rate policies like Europe and Japan, savings rates actually go up because you have to save even more because your nest egg is kind of being whittled away. I know it sounds backwards, but that's
really counterintuitive. It would just be easier for me to just buy more gold or silver. Unless they're forcing us into the banking system, right? Unless they're making it required that we keep some at the banks, a certain amount at the banks, and then pay fees for negative interest rates. But I mean, someone's going to say, well, I don't want to pay those fees. I'd just rather have gold or silver out of the system.
There's a lot of different forms of value and monetary units, 100%.
Okay, well, I've had a really interesting conversation with you. One more question before I let you go. So with the strong dollar, if you're correct, is this going to absolutely kill emerging markets then? Because it seems they have a lot of headwinds going for them. So there's the commodities bear markets for oil, energy, base metals. The Chinese economy was the one slowing down first, and a lot of these emerging markets were exporting luxury goods and commodities to China. So they were already slowing down most of 2019. And then you have a lot of these emerging markets with too much dollar-denominated debt. So what is your opinion then of what's going to happen to these emerging markets? Because I'm seeing a lot of people recommend that these emerging online, that these global macro experts, that these emerging markets are really good value plays right now because the dollar is going to get weak and emerging markets have bottomed out. What's your opinion on this?
What we've seen all throughout this last 10 years, this is not an exact replica of what is happening with the emerging markets, but value is cheap for a reason, and growth has been paying off, right? So, I mean, the stronger companies, usually have a reason why they're having higher PEs and stuff like that. I think you can apply the same sort of logic to emerging markets. I mean, I still believe that the U.S. will still come out better from this than these emerging markets. In other words, like if my wave 2 theory is right, and we're going to have another wave 2, both from the fact that just the way the virus works and the way that weather works, you're going to have another wave 2 there. You're going to have another wave 2 in kind of layoffs happening as corporations kind of recalibrate and assess the new world that they're living in. That's on the domestic front. Those same issues are happening globally. And then you throw on top of that the things you mentioned around the dollar, and in some of these countries that were based on the just-in-time supply chain management input as part of the chain. If they start to lose their competitive advantage or get forced to kind of see some of the production come back to the U.S., they're going to lose out from that. And they're also in a situation where their healthcare systems are not as able to kind of combat this COVID crisis. And that's going to be other kind of disruptor. Unfortunately and sadly, it's going to be a huge disruptor for a lot of these emerging markets, which will further kind of weaken them at a time where they're already weak. So I think the wave 2 analogy also applies to emerging markets. I'm personally not involved. And I think that there's going to be better value ahead for emerging markets.
Yeah, I did a short video on emerging markets recently, if they're the new subprime, and I said the emerging markets really need 2 major things to happen for big improvements. So they either need a weaker dollar to help with their dollar-denominated debts, or they need a rally in commodity prices, or the Chinese. I guess the third one would be the Chinese economy starts to rapidly come back because they had the coronavirus first. So any of those 3 scenarios, maybe a couple of them would really help emerging markets, but I don't really see any of those things playing out for at least the short term.
Yeah, I think it's all about timing. There's going to be great value, but it can get cheaper, is my view.
Yeah, I think at some point for some of these oil companies, some of these copper companies, China will eventually get back to some normal economic activity level. So there will be good bargains there. But I think until we get there, there could be a lot of bankruptcies. especially with the copper miners, from what I'm hearing from my friends who are royalty and streaming company executives who are looking at doing deals with these copper companies. I mean, they've been saying for a while now publicly that a lot of these copper companies are not going to make it.
Yeah, so I mean, there's all these little niche plays that you know better than I do, and I think that I think being patient. I mean, really being patient. We're conditioned to kind of move quickly in markets because we've seen central banks always kind of getting our backs, and FOMO trades, and everyone always thinking that they're going to miss out. I think patience is really in order at this juncture as we head into the next two or three quarters, and we'll come out of this and we'll be stronger for it. I think, especially in the U.S. And we'll see probably inflation, but maybe that's what they want. And we'll see a real shifting of who are the leaders in investments and within sectors, which ones are going to be outperforming, and it won't be your standard suite that we're accustomed to.
Yeah, I think inflation, deflation, stagflation, I think gold's going to do well. Maybe in the short term, there'll be some corrections, a lot of volatility along the way. I think ultimately, because of the currency instability, all the political headwind, all the different rules changes from politicians, the central bank balance sheets, I think gold's going to, and what's going to happen with interest rates and central bank intervention, government intervention, rules changes, I think the gold price is going to do very, very well in all currencies.
Indeed.
Well, I want to thank you again for your time today, George. If my listeners want to follow your work, so right now you don't have a paid newsletter. So if my listeners want to sign up for your email list and get some updates about the government bond market, U.S. Treasuries, and corporate bonds, how do they do so?
I think the easiest thing to do is just to kind of follow me on Twitter. I have a @bond strategist is the handle on Twitter. I also have a web page. I'm just kind of slowly trying to figure out how to build it and organize my content. But and I also produce work as a contributor at times with the Quill Intelligence with Danielle DiMartino, but also with an outfit called macrohive.com. But just considering I have no official sort of paid letter and I'm just doing this pro bono at the moment just to kind of get my word out there, the best way is to kind of track me on Twitter. And then if you're interested, go to my website. It's called thebondstrategist.com, and you can email me there if you want to be on any future list that I may create.
Very good. And each week you come out with a pretty good summary of the Fed's balance sheet. So it's right there. It's a screenshot, basically. So you have everything you need to know in 1 or 2 tweets. It's really efficient.
No, I appreciate that. Yeah, I'll keep doing that because they're not going to go away anytime soon.
Well, I think you could probably eventually parlay this into a different type of bond newsletter because there's just not a whole bunch of them. I mean, a lot of them go around investment banks, but I don't know if there's any products like that for people on Main Street who are looking at different bonds right now.
Yeah, no, I think it's a huge opportunity, and I do think that there's you don't want to actively trade bonds the same way that the institutional investors may do, but being small and nimble has its advantages, and there's a lot of new products, in ETFs where you can basically replicate a lot of the same strategies. And so I think ETFs is in very high liquid credits and government bonds can really be used to implement similar strategies of where you think rates are heading, curves, spreads, and I think retail, those that are interested that could do those sort of trades and are comfortable. There is I think it's going to be a sector that will grow, and I think that we've seen other retail investors globally, like in Japan and Europe, become more active bond traders, even with rates being low. I think that the U.S. is going to have to learn that as well.
Great. Well, thank you so much for your time today, George, and keep up the great work.
Appreciate it. Thanks for having me on.